Welcome, dear traders. Wall Street has been gripped by uncertainty once again. Investors struggle to see a clear-cut trend. It's extremely difficult now. Stocks managed to perform a dazzling upward rebound at the end of May. However, they will hardly be able to maintain upward momentum. Besides, traders are worried that the recent sharp jump could be just a new sign of the bearish trend. There are plenty of reasons now for staying alert. Firstly, the previous sell-offs were followed by several false rallies. Secondly, recession fears are intensifying. Inflation may undermine a steady economic expansion, and which has been going on over the past 2 years. Consumer prices are rising at the fastest pace since the 1980s, forcing the Fed to take more aggressive measures. Traders are anticipating the CPI report, which is on tap this week, and the May figure may once again confirm a slowdown in inflation. In April, the consumer price index fell for the first time since last August, and some economists believe that the reading may slide to 8.2% in May. However, inflationary pressure remains persistently high. Brent crude climbed over $120 per barrel for the first time since early March. Back then, inflation soared to a 40-year high. Find out more details about the stock market by watching our video review. Feel free to leave your comments down below, and let's get cracking. Wall Street ended last week on a pessimistic note. The main stock indexes made several attempts to recover, but to no avail. For example, on June 6, stock indexes rose by more than 1% at the opening of the session. Investor sentiment improved significantly amid positive news from China. Nevertheless, they were unable to hold on to the gains. At the end of the session, they slipped again. Inflation has turned into a nightmare for stocks. Market strategists are confident that it has not reached its peak yet. On a Friday, the fresh inflation report may unpleasantly surprise investors. Naturally, it's weighing on the sentiment. To this end, risk appetite has decreased again. Trading has become more sluggish in the recent days. Apparently, traders are sitting on the sidelines. They are in no hurry to open new positions ahead of inflation data. They have also factored in the upcoming rate increases by the Fed, as well as the likelihood of an economic slowdown. Intraday volatility is still high, however, it seems to be easing. Now, it's important for investors to understand whether the equity market has fallen sufficiently, taking into account the Fed's aggressive monetary policy. Perhaps it has already hit the bottom after closing 8 of the last 9 sessions in a negative territory. New CPI data is sure to provide more clues on this matter. Let's move on to the stock indexes. The Dow Jones consolidated around the 33,000 level after logging its best weekly gains. It undertook several unsuccessful attempts to climb higher. After that, the Dow shed 0.9%. At the end of the last week, investors digested the non-farm payrolls report. The May reading turned out to be quite positive and even topped economics forecast. The unemployment rate remained unchanged, and the economy added 390,000 new jobs, exceeding the preliminary estimate. The April indicator was also upwardly revised. Stocks were down following such upbeat data. Strong non-farm payrolls may be a signal for the Fed to continue monetary tightening. It appears that the stronger the economy gets, the more stubborn the Fed becomes in its desire to raise the key rate. Of course, it's bearish for the stock market as rate hikes are hurting its fragile recovery. Notably, there was a similar reaction to the manufacturing PMI index revealed on June 1. The figure also surpassed analyst expectations, indicating a considerable improvement in the economy compared to April. Stocks fell immediately after the release of this report. The US dollar and the US Treasury notes, on the contrary, surged. The Fed is likely to stick to a hawkish stance to cool the economy amid relatively positive macro stats. Perhaps monetary tightening has not brought the desired results yet. It may also be ineffective in the fight against inflation. And in this case, the Fed will have to take a more aggressive approach by hiking the interest more times. If so, the clouds over the stock market will begin to thicken. Like other stock indexes, the S&P 500 ended last week with losses. It dropped by 1.2%. The index has been moving mostly in the sideways range throughout the week. It broke the 4,100 level on May 31 after having hovered around this level for some time. Judging by its dynamic, the index is losing its bullish momentum. The nearest support level is located around 4,060 and 4,100 points. The S&P 500 is likely to stay in the sideways channel until the release of the CPI data. The index may resume an upward movement only after breakout and consolidation above the 4,200 level. The nearest resistance level is located there. June is hardly a good month for investment. In the early summer, the stock market is usually facing difficulties. Over the past decade, Wall Street has grown by an average of 1.4%, making June the fourth most gainful month in 10 years. However, some analysts reckon that a bad year for the stock market may end with the beginning of summer, clearing the reputation of June as an unsuccessful month. This is why a sharp rebound at the end of May, when the S&P 500 surged by more than 6% in a week, may turn into a summer rally. The heavy tech NASDAQ also ended the week in the red. Following the results of 7 unsuccessful sessions, it sank by 1%. Its dynamic is similar to other major stock indexes. It's largely moving in the sideways channel. The index may escape the narrow range after the release of inflation data. The Fed is sure to take decisions at the June meeting with this report in focus. If inflation rises in May, it will inevitably affect market expectations for rate hikes, as investors keep close tabs on news about inflation and interest rate increases. It will be interesting to track the movements of Apple and Tesla shares. Apple will make some important announcements at the conference held from June 6 to 10. They will determine the main strategy of the company for the next 12 months. And the Apple shares climbed by 1.9% on the first day of the conference. New features and updates could make Apple's stock more attractive. They have fallen by more than 18% this year amid a large-scale sell-off in the tech sector. But Tesla plans to cut about 10% of its staff due to the gloomy economic prospects. A week ago, a letter with the title "Suspend Hiring Worldwide" was sent to Tesla's top managers. Tesla shares decreased by almost 9% following this news. Investors expressed concern about the automaker's profit outlook for the current year. Twitter stock is also in the limelight. Musk threatened to terminate the deal as Twitter rejected Musk's request to reveal the number of fake accounts on its platform. Twitter shares dipped by more than 3% following this news. Subscribe to our channel and stay up to date with the latest market news. That's all for now. See you soon.